Ladies and gentlemen, good day and welcome to the Q2 FY24 conference call for Asahi Songwon Colors Limited, September 2023 result discussion. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that the conference is being recorded. I now hand the conference over to Mr. Abhishek Mehra, sir. Thank you, and over to you, sir.
Thank you, Akshay. Welcome everyone, and thank you for joining this Q2 FY24 earnings conference call of Asahi Songwon Colors Limited. The results and investor updates have been emailed to you and are also available on the stock exchanges. In case anyone does not have a copy of the same, please do write to us and we'll be happy to send it over to you. To take us through the results of this quarter and answer your questions, we have with us today Mr. Gokul Jay Krishna, Joint Managing Director and CEO, Mr. Arjun Jay Krishna, Executive Director, Mr. Mitesh Patel, Executive Director, and Mr. Saji Joseph, Company Secretary and Compliance Officer. We'll be starting the call with a brief overview of the business and the financial performance in Q2 FY24, which will be followed by the Q&A session. I'd like to remind you all that everything said in this call reflecting any outlook for the future, which can be construed as a forward-looking statement, must be viewed in conjunction with the uncertainty and the risks that the company faces. These uncertainties and risks are included but not limited to what we've mentioned in our annual report, which you'll find on our company's website. With that said, I'll now hand over the call to Mr. Gokul. Over to you, sir.
Good morning, ladies and gentlemen, and it's a pleasure to welcome you to our investor call this morning. Our performance for the quarter was consistent with our prior guidelines of achieving break-even at PAT level in this quarter. We have been able to do that despite very, very challenging market conditions and very tepid demand. So in the last investor call, when we had had a very poor performance earlier, we had envisaged that the markets will improve. This has not happened. The demand remains very sluggish even now, particularly in Europe, though we have seen pick up in US, which is very promising, and India remains very strong, dominant. So our concentration in business in India also has been consistently going up. However, despite these market conditions, we are happy that our team has been able to improve operating performance, and due to that, what we had earlier, very negative performance, we have broken even at the PAT level as we had envisaged and guided earlier. I will take you through some of the highlights that have happened in the last few months. One, we have been able to successfully sell the Saika land at a price of 48 crores, and this has resulted in a net profit of about 24 crores. This transaction was completed extremely smoothly, and the proceeds have all been received. The tax on the transaction also paid, and everything is completed. This has resulted in improved debt position of the company, where we had last Concall guided that our peak debt would probably be coming to about 225 crores at peak level sometime in 2024. Now we have revised that guidance to a peak debt level of 175 crores, or maybe even 170 maybe the peak. So this is much improved from the earlier guidance that we have given. This is based on two things. One, the sale of land, which has brought in free cash, as the land was not going to be utilized after our move to buy the pharma business and put up a new greenfield project of pharma at Chhatral. So this went on very smoothly. The second reason for improved guidance on the overall long-term total debt would be our improved cash flows. So all three verticals are showing improved cash flows despite not being very profitable. And so that is one of the highlights. The second one, this is a major one. Just on Dussehra, 24th of October, we have commissioned and broken ground on our greenfield project of Atlas Life Sciences in Chhatral. So the intermediate section of Atlas in Chhatral is now operational from 24th of October this year. This puts us in a much better position for the next 6 months at our Atlas order site as well, because we hope to be completely self-reliant in 2 of our main raw materials, N1 and N2, from the month of January itself, or January of 24. The third fact that I wanted to just bring to your highlight, and then Arjun, our Executive Director, will go more in detail and give his views on it. But our ATC team at Dahej has done extremely well, and despite very, very challenging demand scenario and no improvement in the market, we have EBITDA broken even at ATC finally, as we had foreseen, except the fact that we had not foreseen the demand to be this weak. So we are happy that despite the poor demand, we've been able to have a EBITDA break even coming up. And we look forward to demand improving in the next quarter, or definitely in the last quarter of the financial year. And then that will have us very well placed going forward. The final thing, on a consolidated basis, where we had a PBT of negative 7.5 crores, we are nearly breaking even on a PBT basis on a consolidated basis. So this is reassuring in the current circumstances when markets are very challenging, and gives us a lot of hope that with the efforts that our team has put in to reduce costs and improve overall performance, we should be able to take advantage of the markets when they revive and get back to normal profitability level. With that, I would like to hand it over to Arjun to give his views on the recent performance. Arjun, over to you.
Yeah, thank you so much. Good morning, everyone. I'll run you through a quick summary of the performance and update you on the recent performance for the ATC part of it, and briefly touch upon the API segment as well. So we continue to witness improvements in our agro business, as has been mentioned by our CEO right now. In the last quarter, we operated at around 40 to 45% capacity utilization. Despite a challenging market and challenging market conditions for agro pigments in general, our performance in this segment is showing progressive improvement. So this quarter, we successfully were able to launch a few new products in the red pigment range as well. And these continuous product additions have played a pivotal role in scaling up our agro business despite the poor market conditions. On the yellow side, our capital expenditure for expanding our capacity in the yellow pigments remains on schedule, and we anticipate that we will have it completed by Q1 FY25. As the market conditions improve, whenever that may be, we are confident that our agro business will reflect the positive returns on our investment. And while we achieved break-even at the EBITDA level for the agro business this quarter, our subsequent goal is to reach break-even at the PAT level in the forthcoming quarters. So, it is a challenging time to continue and improve on the performance. However, the team is working really hard, and we are exploring several new opportunities in terms of launching new products, as well as trying to expand our customer segment in the agro, so that we are well positioned to grow even in these bad conditions, and be ready and well positioned when the time comes for us with the market picking up. Turning now to our API segment, I am extremely delighted to announce the commencement of our commercial production at our intermediate plant this week. This move will significantly assist us in sourcing two of our crucial raw materials, which are essential for the APIs we produce. We project the ramp up of this intermediate facility by the end of Q3 FY24, which will in turn enhance our margins in the API business. The remainder of our progress is Remainder of our capex is progressing, as planned and is set for completion this quarter. On a consolidated note, it is evident that our business is nearing the culmination of its current capex cycle. Each of our business segments is steadily advancing past their challenging phases. And while a surge in demand might still be a few quarters away, we remain steadfast in our belief of achieving a sequential improvement in our financial performance, and we hope that we are able to use the momentum of the last month in both our as well as API businesses to motivate the team to keep working harder and keep this performance and the slow but steady growth ongoing despite very challenging conditions, and hope to give a good performance in the coming quarters as well.
Akshay, you may open the floor for questions now.
Okay. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Aditya Ketan from Smith Institutional. Please go ahead.
Yeah, thank you for the opportunity. Sir, my first question is, sir, you mentioned in your opening remarks that demand continues to remain weak. So currently, for the current month, are you witnessing any sort of improvement? And if we say that demand is weak, so if you can highlight how much is the inventory in the pipeline and how much more months of inventory destocking we can more see, so demand could remain weak, and how is the situation in the international markets in US and Europe, and by when we can see improvement, if and all, if we hope to see that?
Sure. Thank you for the question. What is your name again? I missed your name.
Hello?
Yeah. What is your name again? I just missed your name.
Aditya Ketan from SMIFS Institution.
Yeah. So, good morning, Aditya. Thanks for your question. So, to answer your question, the demand still continues to be very typical weak. To be very honest, I don't see an immediate demand revival this month or next month for sure. It may be January, February, March at the earliest that we would see a demand revival. In my view, the latest could be by April, May. That is the kind of time horizon, in my view, that we will see in terms of demand revival. So at least a quarter and probably maximum 2 quarters before demand revives. So we now do not wait for demand revival. We have to work in this environment, and I've already addressed the entire team, and we are prepared to improve our performance given the same weak demand environment. This can be achieved by 2 ways. One is increasing the basket of products, which we are successfully doing, as Arjun mentioned in his Concall at ATC at the Dahej plant. We will do the same with the Atlas plant with the start of the Chhatral facility as well. And we are also, so that is increased number of products and the range of products is one way to mitigate the weak demand scenario. And the second is by increasing the breadth and the number of your customer base. So we are approaching new customers, and we are doing this successfully in 2 ways. In ATC, of course, we are new and we are approaching a lot of new customers, gaining new customers. With the old view business, we have gained some customer base in India as well. So the business in India, where the demand is good, we have strengthened and are improving as a percentage. It's already now 40% 45% of our overall business, which it used to be at 10%. So these are the two strategies we apply to so that we are not reliant on just demand revival. When the demand, we should be prepared for demand revival in a way where we are, where we reduce and improve our cost efficiencies. So whenever the demand revival comes, we find ourselves in terms of cost as very efficient, better than we were before, and two, with a more a broader range of products and increased range of customers. That would probably put us in the best position to take advantage of the demand whenever it comes. This is what we can control and impact ourselves. The demand itself, we have no control over. So we do not want to worry much about the demand. We don't care if it doesn't come for the next 3 months. We will still continue to improve our Q-on-Q performance.
Okay. Sir, is there any situation of an excess inventory still into the pipeline? And so that is also like...
So good question. Sorry, I didn't answer that earlier. So this problem is now already sorted out. We had a huge problem of inventory overhang, for which we suffered losses over the last 6 to 9 months, as you all know. That was one of the key factors why our performance was negative at a PAT level and even slightly negative at EBITDA level. These days are over. So I will take you through all the 3 verticals so I answer your question very directly. So in the blue business, our inventory today stands at 600 tons, where it stood at 1,400 tons in November of 22. We were at 1,400 to 1,500 tons. Today we are at 550 to 600 tons. So and whatever inventory we have, this is the minimum inventory we like to have, because we make about production of about 1,200 to 1,300 tons of blue. So holding a 5 to 600 tons, 10 to 15 days inventory is the bare minimum we need to do for our customers. Also, the inventory that we now hold is not high cost inventory, because the prices and the markets have bottomed out, and we are not seeing in the last 2-3 months any deterioration in the market. While there is no demand revival, there is no deterioration further, and inventory overhang is completely over. So now there is no inventory sitting on our books where it will result in losses as it did for 6 months. With Atlas, at Odor, our inventory levels are at absolutely close to zero on the finished goods side. We have no inventory, not even a week's inventory. And we are booked at Atlas Odor in the pre-gabalin business for the next 45 days. This is the first time in the last 12 months that we are sold out for a month and a half or 2. Earlier, we were fighting to sell material because the markets were weak. Next question.
Thank you.
I hope I've answered this question.
The next question is from the line of Keshav Garg from Counter Cyclical PMS. Please go ahead.
Sir, I'm trying to understand that on a standalone basis, we did a peak quarterly revenue of around 120 crore in June of 2022, which has now reduced to 58 crore. So basically, it is just half. So if you could just give us some idea that how much was the volume degrowth and how much was the realization degrowth from peak till now?
So prices have come off by about 25%, and volumes have come off by about 35%, 40% even.
Okay, sir. Sir, and also now with crude prices again going up, sir, what kind of impact do you see on our realizations going forward and margins?
So we see that margins and realizations both have bottomed out. This is, to me, in my opinion, this is very clear. Even despite a weak demand scenario, we see improvement, gradual, slow improvement in both volumes as well as margins as we go forward, and prices have bottomed out. So prices, why? Because of the weak demand scenario, the prices are not going to shoot up quickly. However, we are seeing that prices have bottomed out, so there is going to be a gradual upward move in the prices of pigments as well. Same for API. Same for API.
Sir, also if you could give us some idea that, sir, if we operate at full capacity utilization, then, sir, what kind of revenue can we generate in our all three segments? So the blue, the azo, as well as the API.
So the combined revenue that we can generate at peak performance without counting Chhatral facility of Atlas. I'm clarifying this because it's a new facility and right now there's no point of counting it. So we can generate a peak revenue of about 400 crores in the blue business, about 150 crores in the ATC business, and about 125 crores in Atlas odor business.
Sir, and also, sir, with this new capex of around 70 crore, sir, what kind of IRR do you expect on this investment?
So the capex is going to be in the range of 70 to 75 crores, and we are looking at a turnover of about 200 plus to 225 crores at peak levels from this capex. When the API plant and the intermediate plant both are operational, and we estimate a EBITDA margin of anywhere between 12 to 16%. Of course, it won't be 16% in the initial year, but eventually at peak performance, we should get EBITDA margins of about 15%. So the math will be easy. I mean, 225 crores turnover on 75 crores of capex with an EBITDA of 15%.
Great, sir. Sir, lastly, sir, if we see our API revenues, sir, year on year, they have fallen from 70 crores to 23.5 crore. So is there any, I'm trying to understand, have the volumes realizations gone down or was the plant inoperational? What exactly was the reason for that?
Sorry, can you repeat that question? I did not get the first two lines.
Sir, in our API division, in the second quarter, year on year, last year we did 70 crore revenue, which has fallen to 23.5 crore. So that's a pretty drastic fall. So what exactly was the reason for such a fall?
You're talking about the half yearly?
No, sir, I'm talking about second quarter.
Second quarter API business 70 crore.
Sir, in the segment results, if we see, then, sir, maybe it might be a misprint, but it shows.
Alok bhai, can you clarify this? Because I am confused with the quarterly revenue of 70 crores in the API business may be a typo. Alok bhai, please clarify. One minute. Hello, Alok bhai?
Yeah. Sir, this seems to be a typo.
Yes. Okay, sir.
Yeah.
So thank you very much and best of luck.
Sorry for the typo. I mean,
no problem.
But yeah, so I'll still take the question. So there is, I mean, obviously it's not that drastic. There is some reduction in the overall turnover. The typo is in the prior quarter. This quarter, yes, your number is right, 25 crores, and it's below, slightly below our estimate, but not in a huge way. I attribute that again to a combination of weaker demand. So the volumes were lower by about 15% in the odor Atlas facility, and the prices were off. The pre-gabalin main product prices fell from 4,000 to 3,000, so about 25% reduction in prices. So this was the combination that resulted in some depletion in the turnover. In October, November, December of this year, we see that the turnover should be inching back to its quarterly norm.
Great, sir. Thank you very much.
Thanks.
Thank you. The next question is from the line of Vaibhav Barjatia from Honesty and Integrity Investment. Please go ahead.
Hi, sir. Thanks for providing the opportunity. So a couple of questions on the pigment business and a couple of on the API business. So first on the pigment one, so see from a relatively longer term perspective, we see, some of your competitors are positioning themselves more as a competitor to international companies like DIC, Clariant, and their forward and they're kind of forward integrating into that domain of the business. While we continue to be positioned as a supplier to these companies. So, any thought on how you whether you want to make that transition at a later date, or you think that the transition just doesn't fit our business profile?
So right now, for the pigment business, we don't intend to get into forward integration in any of our pigment businesses, which is master batch, paint, or inks. However, one cannot tell too long term. As of right now, we have no such plans for the next couple of years. As Arjun mentioned in his introductory speech, we are coming towards a long capex cycle, probably one of our most aggressive capex cycle in the history of 25, 30 years of our existence. This has run the last 24 months and is coming to an end in the next a few months, in the next 3 to 4 months. We have only about 20 crores of capex to go, 10 at Last Chhatral Greenfield project, and about 10, 12 at the ATC Yellow expansion. That would be the end of our capex cycle, and then we go into a year or two of your consolidation. So we have no future plans of capital allotment to expansions right now. We would like to rather fulfill the potential of the existing capacity. Arjun, do you want to comment on it? Anything you have?
Yeah, so sorry sir, just to interrupt in between, but so for example, like I don't know, my understanding might be wrong here, but for example, the guy like Sudarshan, they always say that DIC, Clarion, these companies are their competitor. While for us, I think they are our customers. So I just want to understand that why this is the difference and whether you want to migrate upwards.
No, we are happy to be having DIC and Horvath and Clarion as our customers. And they are excellent companies, and we have a lot of potential to grow supplying to these companies. Arjun, do you want to comment further?
No, I think you said it. You said it perfectly. But to answer that question, yeah, I think we definitely one of the things we pride ourselves in is being the lead and primary supplier to the top in the world. For example, DIC Sun. We are also lead supplier to Clarion. So I think for now we definitely aim to continue this. We aim to continue our presence in our supply to them. We hope to be a wholesome pigment supplier to them, and we see them as a very large global MNC player. And with them growing and further being stronger with DIC buying, taking over BASF, we see that there is more growth for us to do business, and we are getting stronger on a global scale, which allows us as well to use our relationship with them to increase our business, support them, and together have Asahi grow as their supplier, which is Asahi growing is of primary importance, and our way of doing that would be, to support them, and they are very large, very, very strong MNCs, and we think that they will do really well, and we hope to keep growing our business with them in the coming years.
Okay, got it.
I will further clarify. This is a good question. So do not mistake what me and Arjun said, meaning that we are not competing with them. I mean, we clearly compete with Clarion and even DIC for that matter at times for the pigment business. What we were trying to answer was that we have no intention for getting into forward integration into inks or paints or plastics. But that doesn't mean that we are not going to compete with them in pigments. So let me clarify that in pigments that we will continue to compete with them, and I feel that we will definitely be far more competitive than them, and that is why we feel that overall, I mean, I don't want to name anyone, but we will gain not only growth in the pigment business from the incremental growth in the business that we see, the generic growth in the business that we see year on year, but we will also gain because we will compete better with various companies in the pigments without naming them, and some of them could be big multinationals too, and they recognize this already, that it is not possible, it probably won't be possible for them to compete with companies such as Asahi, and they would probably transfer some of the business either to Asahi in a relationship or, we will eat into some other companies' pigment businesses as well. So as far as pigments are concerned, we are there to compete with all of these companies. What we meant is we are not going to go in for forward integration at this stage for the next 2 years.
So I think that answers my question. And secondly, that's kind of a historical question, but I just want to understand the logic. So, when we as of now, we are already close to the completion of capex cycle. But when we originally decided to put capex at various fields, so you have earlier highlighted that there was an environmental permission issue for expansion of blue business at existing location. So why have we never considered at that point of time any greenfield expansion of the blue business as such? Was it at that time related to market or is it something else?
So we have debated this question. That was the obvious thing. I mean, when if you look back 5 years into our business, even 3 years back, we were a single product, blue, single location, Baroda company, right? Now, and we are market leaders in the world for blue. We are number 1 in the world for blue. This is our strength. We know the blue business inside out, and we feel that we are the best competitive company if you take customer profile, quality profile, volume profile, and put it together. So the obvious question when we had to decide 3 or 5 years back what we want to expand into, obvious answer was blue. However, at the board level and the strategic level in the company, we came to a conclusion that we do not want to put any new further money into the blue business because blue is already dominated in a significant way by India, and we do not have any incremental growth coming from competing outside India companies and gaining their business, like we could gain AZO business from China, something like that.
Okay.
So we have strategically decided, and we stick to that we will not expand or put capital into the blue business on a greenfield expansion side, because also what that would do is that would in a way be hitting our own business, because we would have to then approach lower quality customers with lower margins, lower pricing, and that would hamper our business with our quality customers that we have.
Okay, got it. Understand. And now coming on to the API side.
Mr. Vaibhav sir, may we request that you return to the question queue for the follow-up questions, as there are several participants waiting for a turn.
Sure, I will come back to the question queue, no problem. Yeah.
Thank you.
Thank you, Vaibhav.
The next question is from the line of Dhiren Anuragi, an individual investor. Please go ahead.
Hi, sir. Am I audible?
Yes, sir. Please
yes.
go ahead.
Okay. So firstly, congratulations on commissioning of the new project. I think it is especially commendable that you have gone ahead with this project even during the current industry scenario and have completed it on time as you have committed. So kudos on that. My first question is regarding the new API site only. I think in the AGM before you have communicated and even today that the turnover potential of the site is 200 to 225 crores. So I just wanted to get some clarification that this includes the value of intermediates also which will be produced, or you are only talking about the external sales potential of this site and the value of intermediates which we consume internally is different?
Thank you for the question. Thank you. We always like individual investors to be on the call, so thank you for being on the call. And your question, Arjun, can we take that question? Hello? Yeah.
Yeah. Thank you for your kind words. And to answer your question, the turnover that they will would be the turnover from sales. So internal use would be over and above this.
Just to understand, sir, if we add the intermediates as well, or if we take them at market value, then what is the value of production out of that site? Is it like more than 250 crores? Because we're talking about an impressive 4x asset turn then on a 75 crore capex. So if we include the value of intermediates, then what is the value of production from that site?
So as Arjun said, the turnover of 200 to 225 crores would be stick only from the API side. And he clarified that the intermediate business that we consume internally is not counted in the 200 crore turnover. So yes, the asset turnover on a X sector would be quite a bit more. It's like, with the turnover to investment of 75 would look to 200, say 210 to 75. But if you add the intermediate that will self-consume at market value, the X factor would be more.
Okay.
The turnover that would be, I think, in the range of about 60 odd crores or 70, Nitesh. Arjun, any number that you have? What the intermediate, the two products that we make, if we self-consume at market cost, what would it be?
The total site potential turnover would be 350 to 400 crores.
Yeah. So I would say added 100 to 120 crores would be what the intermediates would be considered at if you consider it market value that we'll consume internally.
Understood. Okay. So this is quite impressive in terms of the fixed asset turn. So we are able to achieve this because the 75 does not include the value of land which we had acquired from the subsidiary. Otherwise, this would have been lower, or is it like we are doing N-1, N-2 manufacturing, and that is why the asset turn is higher? Because if we compare it to what the current fixed asset turns for many of the API plants coming up, even 3 is a very impressive number. So here we are talking about at least more than 4. 4.5 maybe, if we include the value of intermediates as well.
So I think you answered part of it yourself. I think the N-1, N-2 is a very large factor. That is the reason we have done this project. Apart from this, we also, the projections they're giving, although achievable, we will have to work quite hard to get them. We have a state-of-the-art plan now, so we are hoping that these numbers that they've given, they are of, we would be able to get a slightly better price and go to slightly better markets as well. Where right now we would be in the more unregulated markets, we would move to slightly more regulated markets. That would be one reason. The N-1, N-2 obviously is the largest. The second is the largest reason. And third, we will also, we have worked on over the past few months some molecules. Obviously, we don't have the R&D expenditure that large pharma companies would have yet, but we recognize the importance of R&D in pharma, and we have worked on other products as well, which small products. These would not be too little. However, they are products we have worked on which will be made in our new factory, which will assist these turnover numbers as well, and hopefully help us achieve the numbers we have quoted, as you said, which are as always, which are the benchmark we have set, and hopefully we'll be able to report that we have achieved it in the coming quarters as we do start the plant. However, it will take time, as that said, since it's a brand new plant. But once it is all established, in the long term, we should be able to achieve these numbers.
Okay. So the intermediates that we are producing for pregabalin, CMH and RCMH, will these intermediates are we going to manufacture any other molecules from these intermediates, or they are only dedicated for pregabalin? Or if you're going to leverage this for some other API as well, which we may not do currently?
No, we would be, as of right now, we have targeted it only for pregabalin, two intermediates. And if we have anything in excess from what we use, we would probably be selling it into the market.
Okay. And if I understand
a similar strategy to what we have done in the blue pigment business. We consume, we make CPC blue crude, the main raw material for the blue pigment, and we make in excess of what we consume, and we sell that to some of the multinationals.
Okay. So in pregabalin, post these two intermediates, would it be safe to say that we would be the most integrated player? I think it's a 4-step process, and we would be covering it till the very first step only. So is it safe to say that we would be one of the most competitive cost producers in this in India post the expansion?
Yeah, I can take that. Yes, it is safe to say that. However, we do really have a long way to go still. We have said, as a strategy and what we have discussed previously, in calls as well, we have a strong position already. However, because of not being backward integrated, we are not able to, despite having a large enough market share in India, we are not able to get the numbers we want. This will definitely make us, in India, one of the more dominant players in terms of backward integration, and we already have a good market. What we aim to do is raise our level in terms of compliance, which is a reason for a large investment in this plant, and move not only to India and the non-regulated markets to more regulated markets, where we have obviously other competitors who are much larger players and much more recognized players. But we hope that this backward integration and a state-of-the-art plant will allow us to move to that level, while we also have the Indian market in mind and growth within this segment where we are going to be dominant, but to raise our level for the slightly more regulated markets as well. So that is where we'll work really hard and aim to put our presence there as well.
Understood. So just one last thing. So from a capital allocation point of view, this recent land monetization was a very welcome move. So is there any such other asset available which the company may look to monetize? And, potentially if we look at the value that we are currently getting in the market in terms of market capitalization, maybe deploy some capital towards a buyback or something which can, actually be of use to the long-term investors, because I see there's a lot of value. 3 years ago, also we were at the same market caps, but in 3 years, basically, we've added 2 new businesses of equal size and opportunity as compared to the blue one. So any thoughts on this would be really welcome.
Yeah. So in terms of the capital, what was your first question? The second one I understood.
Capital allocation. So any land monetization or other asset monetization?
No, got it. So the first question, no. We don't have any other assets like the land parcel we sold that we would monetize and, and get money from. And the second question was?
So if we have, let's say, surplus capital which can be deployed to a buyback or,
So we have done buybacks in the past, and, we will hope to have surplus capital sometimes in the future. So at that time, the option would be either to do another buyback and reward our existing shareholders. And as you rightly said, I mean, from the valuation point of view, we are at where we were 3 years back. But on the turnover or investment or business side of things, we have become much more different in terms of the company. Of course, the times have been tough because interest rates have gone up and markets have crashed, and that's why we probably had a difficult year. But certainly we would either look to do a new capital allocation into the existing lines of businesses which are most profitable after 2 years or 3 years, or if we don't have anything obvious, then repay our shareholders via buyback.
Noted. Okay. Thanks a lot for this, sir. Thank you. Best of luck.
Thank you. The next question is from the line of Rupesh Tatia from Intelsense Capital. Please go ahead.
Hello, sir. Can you hear me?
Yes, sir. Please go ahead.
Yeah, thank you. Thank you for the opportunity, sir. I have 3 or 4 questions. So the first question is, if we look at the blue business, right, standalone business over multiple years, our gross margin has been between 40 to 45%. But in last maybe 10, 11 quarters, it has really reduced. And we understand because of whatever chemical price inflation, whatever has happened. So do you now see that, so this quarter we have seen improvement because the gross margin in blue business has gone to 37%. So do you now expect that we will be in this 40 to 45% range in blue business going forward?
So we have, Rupesh bhai, always been in that 40 to 44% odd range generally. If you take a little up and down, but generally in that range. And of course, because of the exceptional poor market conditions, we had gone down to really, really bad levels. We are recovering. We are at 37.5% now, and our aspiration would again be to get to 40-45% range. However, I do not see it going to 45% anytime in the next couple of quarters.
Okay. That's good to know.
But I do see improvement, and we would be unhappy if we aren't at 40 or slightly above.
Okay. And another question, sir, is in this intermediate plant, what would be current gross margin of Atlas Life, and how would it move once we start consuming these intermediates?
So Rupesh bhai, I'll honestly not like to dwell on that right now because we ourselves are very new at it. So to give any we normally if we give any guidance or comments forward looking, I normally am very, very precise and accurate, and we hope that we live up to it. With the API business, you can understand, very new, so it would be very difficult for me to guide on the impact of the intermediate business. However, this I can tell you that overall EBITDA margins of the API business that we are in, the final API business, should improve because of the intermediate. That is why we went into this business, and it should improve from, say, a EBITDA level of 6% to 12% to start with.
That is good enough, sir. And another maybe supplementary question to that is the capacity we have it to intermediates. How much do we need for our own consumption, and how much would be external sales?
Nitesh?
We have around 20%, 15 to 20% excess capacity of intermediate.
Okay. My next question, sir, is in API products, you have said that, other than intermediates, we are building a capacity of around 200 crore. So can you maybe talk about, top maybe 3 products which will become, 30, 40, 50 crore in the size? Which are these products other than pregabalin, which will give us this 200 crore revenue?
For the 200 crore API revenue from the new Chhatral plant, we would probably depend on the same 6 molecules that we make currently at Odar. The predominant one will be pregabalin. So I would assume that probably nearly 100 crores would come from pregabalin, and the balance 100 crores from the 5 other molecules, and some minor revenues would come from new molecules that Arjun touched upon.
Okay, I see. And my final question, sir, is in the AGM, you have talked about that Arjun, I think, was looking at some cost breakthrough in some red products. So maybe if you can give an update on that, have we achieved that cost breakthrough?
Can I go ahead with that?
Yeah.
Yeah. So, yeah, I think it was mentioned we have been working quite hard to optimize these products. So what we have discussed earlier in the past few meetings over the last, year or more than that even, the red side has proven to be a little more difficult than the yellow, and primarily it's because, we are competing a lot with China, obviously, who hold the dominant space in Azure. And for the reds, everyone else whoever, all Indian manufacturers have to still purchase some raw materials for the reds from China. So that was the reason why there was a price issue in the reds as compared to China. To answer specifically your question, yes, we have been able to get a cost breakthrough in one of the key products. We are working on this, and because of this cost breakthrough, we are able to compete with China. So, it is something we have taken pride in. However, it is not something that will give us, crazy margins. It will, however, allow us to compete with China, which is a very difficult thing in the red. So, we are hoping, there are several discussions going on, as I said, and we are hoping that this process breakthrough that we have had will allow us to, get sales, which is the most important thing right now, and allow us to compete globally with China in whatever small capacity, and allow us to, pump up the red line as well, which will be a big factor to get ATC to the next level.
Okay, that is good to know, sir. Thank you for answering all my questions.
Thank you for your question.
Thank you. The next question is from the line of Nikhil from SIMPL. Please go ahead.
Yeah, hi. Am I audible?
Yes, sir.
Yeah. Two questions. One is, if you look at our quarterly performance, there is a significant improvement in the gross margin, even though the sales on the pigment side has been lower. So, and even in the call you mentioned that you would like to see the gross margin around 35 to 40%. 45 may take some time. So, this improvement is led by what? Like, is the realizations improving, or is it like there were inventory write-offs in previous quarter which is not there now? Just some light on that.
Arjun? So, to answer your question, I think, as you've analyzed correctly, despite despite the turnover not being better, we have improved our margins. There are a few factors here. One key factor which I'm personally not involved in at all, so I'll give full credit to Dad and Nitesh. Our procurement has been good. Our procurement has always been one of our big strengths, and we have leveraged relationships and leverage that strength to get good procurement and get that very effectively done. So that is one reason why our margins are better. Second, what we have discussed earlier as well, it is a matter of despite the margin, despite the market being bad, we have seen that globally inventories are starting to reduce. So people are now, despite poor markets, having to buy products. So we have always tried. We have always made sure to pride Asahi as a very, very high quality manufacturer, which we will always hope to sustain. So we have seen this purely because of us still maintaining a very good quality product, good procurement efficiency, and hence we have seen a comeback, to some extent, at least in the margins, despite demand not yet coming back fully.
Okay. Second is
to add a sentence to it, the inventory overhang that we had was causing some of the pain earlier. This inventory overhang, again, I repeat, is over.
Okay. So whatever happens to the pricing, you believe this 35 kind of so between 30-35 is a sustainable margin, and moving to 40-45 will depend upon how prices become.
Right.
Yeah. Secondly, sir, if I look at some of the players in pigment, on the specialized pigments, some of the larger players like Venator and all have filed for Chapter 11 and all. So are you seeing that there is a constraint on the capacities, or in the last 1.5 years, since the issues have been with the industry, are you seeing that capacities are going out of the market or companies are going out? And if you can just help us understand how is the capacities at the global level, and whenever things change, do you think that we would be able to take a larger market share than what we have done all these years?
This is a very interesting question. I'm glad you asked it. One of the gentlemen earlier also kind of referred to it when they asked whether we would like to compete with MNCs. So the thing is, I at the end I clarified that in the pigment space where we are willing to compete with everyone, and we feel that we should be the strongest pigment player in the world, the strongest, the most efficient pigment player in the world. So what is likely to happen is some of these bankruptcies that you see randomly globally will probably continue because they are going to not be able to compete with the likes of us. It's not just me, but maybe some other companies as well, and the likes of India. So the business will, over a period of time, migrate to India in some sense, in some pockets. And we would be happy to take advantage of that business, and maybe even partner with some companies if they would like to, phase out their capacity and make it with us.
Okay, and just last question. See, we've seen in many commodity kind of businesses that the MNCs eventually try to get out of the commodity business and try to go higher in the value addition or the specialized kind of a product range. And this is across industries which are not even related to pigments, but in other chemicals. Are you seeing, in last 2-3 years, what we have seen is there is a lot of consolidation which has happened, change of hands from Clariant going to Hubeck, and so many things happening. Are you seeing that on the commodity plus kind of a segment, there is a gap which is getting created with players exiting?
Yes, certainly. And this will continue at, in sporadic periods of time. But yes, there is a gap that is being created, and there is a gap that is likely to happen going forward. That is one of the reasons why we put up this plant at the age for ATC.
Okay. Lastly, if we have to fill in this gap incrementally, what would be the 3 or 4 key priorities which we would have to work on? I know our brand in the blue and in the pigment space is pretty strong, but other than that, what additional we would need to do? We have the capacity, we have the brand, but other than what are the key requirements you believe the company has to fulfill in order to capture a larger share?
Yeah, so this question you asked is for the blue, correct?
Yeah, blue.
Yeah. So, I think, what you mentioned, those are two important factors, obviously, that we do have a brand value globally, and also we, continue to have a good product. Now, in order to increase or, expand our share, I think we have many times mentioned earlier as well, I think it was in previous meetings, AGMs as well, that we have always maintained a very high level of customer level. We've always only taken the absolute top clients, and there was a reason for this, which is because we have had these large clients buying consistently from us month on month for years. In order to grow the blue business, I think it is important for us to maintain our quality despite increasing our cost efficiency as best we can. So not to change the product too much, and at the same time make sure to be probably a little more aggressive in certain customer acquisition and activities such as that to gain other high quality customers. But in terms of the blueprint and how we make the product and stuff like that, we continue to keep the same. In terms of brand value, there is still work for us to be done, and there is still globally opportunities for us to take, which will require us to have probably a little better distribution channel and target maybe certain areas and well-established companies which are not probably as large, and increase our distribution network there so that we can grow our business despite keeping the quality standards that we have always kept.
Sure, I'll come back in with you. Thanks.
Thank you. The next question is from the line of Pratik Kulkarni from Kamayakya Wealth Management. Please go ahead.
Hello, sir. I just wanted an update on the approval from the European authorities for our API business. We wanted to enter that segment as it's more regulated and can give better margins.
What is the question?
I wanted to know the updates for the approval from the European authority in our API businesses.
So we have yet to. I mean, that is our ultimate goal. However, we are very new. So the Chhatral plant just started 24th of October this year. So we get the intermediate plant running, then we get the API plant running in the next 3 to 6 months, and then then we apply for European accreditation. So it's a long way to go yet. But yeah, we do definitely aim. We have put up the greenfield plant with the aim to get European accreditation.
Okay. And on our Azo side of business, we were looking for approval from customers in the European region. But as we can see that the European region is currently going through a tough phase, then are we focusing on these approvals, or our focus is shift to domestic markets?
So I'll take that question. So in terms of our focus, the European, as you rightly said, the European economy is going through a difficult time. Companies that are going through a difficult time, coupled with the general slowdown in the chemical industry, is why we have not yet had large orders and breakthroughs there. It continues to be a market where we feel there will come demand. Demand will come back, and we will continue our exercise with them, continue to use our relationships in Europe, which we have worked on for a long time, and make sure that we have approvals in place, trial orders, try to get the trial orders out and in place so that when the demand comes back, they are able to look at us for commercial orders, because these are very time-consuming efforts with the MNC, since they need several step approvals, whether it is from the lab to the pilot to the plant trials, and then subsequently their customer approvals as well. So, it's a long process which we will continue to do, and we hope that when the market returns, it will be a fruitful exercise for us, even though we've had to wait quite some time. In the meantime, and also as you rightly mentioned, the domestic market is doing better than the European market. We have for the Azos taken up more of a effort in the domestic market, where as well it is not great demand, but it is better than Europe for sure. So we have focused on that. That is where we have gotten most of our growth from, as you rightly said, and we will continue to put effort in the local market as well. We see India as a market that will continue to grow, and being an Indian company, an Indian player, we are proud to say that the Azo we have done a lot of work in India, and a lot of the current growth has come from domestic sales. So while we continue to work on our European customers, and we are very hopeful that whenever maybe not immediately, but in future quarters, when the demand there rises and comes back, we will be well positioned to also leverage that business, putting the Azo business in a stronger position at that time.
Okay, sir. Thank you. That's from my side.
Thank you. The next question is from line of Praveen Sharma, an individual investor. Please go ahead.
Hello. Hello, am I audible?
Yes, sir.
Yes, Praveen bhai, good morning.
Yeah, good morning, Gokul bhai. Good morning, Arjun. Gokul bhai, I have only two questions. First is on this PG, with this API coming up, the consumption should immediately ramp up, correct? Because we will be in-house consuming the raw material for the PG. So will it reflect in the margins of PG which we are producing currently to the tune of 120 crores?
Definitely, Praveen bhai. The whole premise of setting up this greenfield project, one of the main premise was that we improve our pre-PG margins, which EBITDA margins were, we had a good business we bought, but the margins were always poor. So with this going into N1 and N2, starting of the Chhatral facility should improve the margins to 12% EBITDA straight away in PG, which was earlier at 6%.
Okay. Because so initially we thought
that is likely to happen in the very early stages also.
Yeah, and means I want to just confirm that it will not undergo any approval from the end customer. They don't undertake approvals for the raw material supply.
Understood your question. No, there is no for N1, N2, the two raw materials for PG that we just started the intermediate plant in Chhatral. So these don't require any customer approval from a single customer of PG.
Okay. My second question is regarding Blue. The Blue always has been a cash cow, and the capacity. I didn't think in last 5 years any major capacity have come up, and the kind of end user industry demand we see is it is going up exponentially. Whether it is automobiles, plastics, real estate, painting, and packaging ink. But where did the demand for blue pigment first disappear? My question is it undergoing some kind of obsolescence wherein there is some alternative product which has taken the place of blue, beta blue, alpha blue, or where is the demand suddenly disappeared in last 2 years?
So the second one is simple. So no, blue is not likely to see any obsolescence. There is absolutely no substitute for 15 beta blue and alpha blue, and there is nothing even in research. So there won't be a substitute at least for 5 years. I personally think for 10 or 15 years there won't be any substitute, but at least we can be certain that for the next 5 years there is going to be no substitute. The demand now where it is gone is a puzzling question. One of the we've also tried to ask it ourselves and figure out what's happening. This demand scenario is generally happening not only in the blue but also in the azo market or in the, for example, the dyes market or some other bulk chemical markets as well. But to answer the question on blue, it seems like, in a 0 or 2% inventory environment, the foreigners, the Western countries, US and Europe, were holding material for 6 months. Now suddenly 6%, they are faced with 5 and 6 and 7% interest cost, and which they have not seen in their entire lifetime of 20 years. This made them panic, and they are now thinking of going to very low levels of inventory because it's very difficult to carry inventory at 6-7%, but it's very easy. It used to be easy, free to carry inventory at 1%. So their whole mindset changed. That mindset change took this whole 1 year exceptional momentum of reduction in global inventory levels. Capped with that, declining market conditions and declining product prices resulted in very abnormal conditions in the demand scenario. Now, over a period of time, this will weather itself out. I think we are at the back end of the low demand environment. And though I don't foresee a sudden jump in demand, but I already see a bottoming out of demand, and probably in 3 months we will see a gradual up move in demand. You rightly said various industries such as packaging, ink or plastic or paints are reasonably good businesses, and these are likely to be good over the future. And hence, I think the general business of blues or pigments in general will be, will have its cash cow statement in place.
Great. Okay, thank you. And congratulations on this good sale of the land. I think these are excellent opportunities, and we are, well equipped, and we have a domain expertise kind of thing in this. So I think we can continue doing that, buying cheaper land and then selling it at a higher price.
Thank you so much, Kavinder. Yeah, I appreciate your words. Yeah, and yeah, we will keep an eye out, from time to time if we can allocate capital where we can make some extra money for the shareholders. Is always a possibility in India, especially.
Thank you.
Thank you. The next question is from the line of Aditya from Securities Investment Management. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. I have a couple of questions regarding our pigment business. So if you could just let me know the end user industry mix for a blue pigment for us and for the industry.
Yeah, so I can take that question. So for us, it is something we have discussed in past meetings as well. We had previously been a largely ink-oriented company, ink end-user-oriented supplier, and we had done very well over the years with this business. However, this was a thing we had realized. We have realized a few years back that we see that the printing ink specifically was a segment that is, in general, not growing. It's steady and even has slight degrowth from time to time. Yet, it continues to be a large volume segment, and there are large players that are continuing to, have very large volumes for printing ink. So we have maintained our printing business, but at the same time, we have made sure to increase our exposure in specifically three segments. One is plastic, one is coating, and one is packaging ink. So within the inks, we have increased our exposure to packaging inks. Packaging inks are obviously a pretty fast-growing segment as consumer goods continue to rise. From something as simple as additional processed foods being sold in supermarkets, etc. Those are all end segments where we have increased our focus. Plastics being another one which has shown good growth, and coatings as well. So these are the three segments where we have consciously made an effort over the last few years to increase our exposure in the blues. And for the Azure as well, right from the start, we have made sure to have a much larger exposure to these products than the others. One other quick comment in terms of end application use. So we have largely been focused on water-based applications as compared to solvent-based in the blue over the years. As time goes by, companies are realizing and appreciating this as solvent-based is worse for the environment. So a lot of companies are attempting to move towards water-based, and this is where our core expertise is and has been over the years. So we will continue our focus on water-based. We will continue, as we have done for the past years, to increase our exposure for packaging inks, plastics, and coatings, and we will make sure to mold the end application such that we still have a position in the printing ink. We are still a dominant supplier for that end application, while also increasing these as we have done for the past few years consciously.
So what would be the share of these three new industries currently, and what was it, say, 5 to 6 years back?
So if I have to give you numbers, I can say that maybe 5 to 6 years back, we would be, maybe 6 years back, around 70% roughly going into printing ink. Now that has reduced to, I would say, around 45%. So it's been a very large change. We have increased these three segments quite a bit, and we hope to, grow these segments continuously as they keep getting stronger in the end application as well.
Got it. And sir, what would be the difference in margins between all these three industries? Because I believe some industries would require higher specificity of the product. So some industries would have higher margins. Could you just help us explain which industries have higher margins?
Correct. So honestly, I'll tell you what you asked. Yeah. So for example, I had some meetings with some customers last week, and within that meeting we discussed the difference between products that go into plastics and products that go into fiber grade. So the fiber grade, for example, has a higher margin and higher requirements in terms of several technical points. Now it is clear that the higher volume products will be going into the ink, plastics, coatings, and applications which are less niche and have much more competition, leading to lower margins. So the large volume business, honestly, even the business that is growing, such as the plastics and coatings, very honestly does not have a special margin or a higher margin. It is just a business that has an end application growth, is why we have decided to focus on it. So we are not able to get much superior margin, but it is a growing industry and we hope to grow our volumes as demand comes back.
Got it. And so in the pigment business, what I understand is the chemistry of the product remains the same for a number of years. And if new players start entering the market, the margins start to deteriorate. And that is why the players tend to move up the value chain and tend to get more into high performance products. So if you just help us explain, have you seen this phenomena in a blue pigment and azure pigment business, that more and more players are gaining entry into this segment, which have diluted our margins, keeping aside the unusual conditions now currently, but even then have the margins diluted what we used to make around 8 to 9 years back?
Yeah, I mean, definitely. I can say that yes. I mean, compared to say 8 to 10 years back, obviously the competition has grown substantially. There are a lot more players in the industry, and I'll also mention here that this is a phenomenon, as you said, has happened in several industries. Here as well we have seen this, and this is one of the reasons why the margins have got cut, because there is a lot of people that have come in and led to oversupply. It is a phenomenon that is happening here as well as in several industries. We know about it, and although it is obviously an additional challenge, we aim to keep our dominant position, and we are confident of keeping a dominant position in the blues, where we do feel that we have a technology and we have a product that is superior to most in the market, and hence we hope to cater to a clientele that appreciates and cater to a clientele that requires and appreciates the higher quality, and we hope to keep that dominant position despite higher competition in the last few years, which I am sure will continue to be the case with this oversupply, but we will not let that deter us. We hope to and are confident of keeping our dominant position in the place.
So I will add to what Arjun said. So this has happened over the last 5 to 7 years, that players that come in because the margins were good, the business was good, no competition, no obsolescence, and a good 45% gross margin. However, it is a cyclical thing that many times, suddenly people come in and the newer ones are obviously weaker players. They don't know the business. They don't know the geographical mapping of the industry, or, making pigments is more an art than it is a science. So, they come into the business not knowing the business well, and over a period of a few years, they wither away as well. This cyclical increased competition and then dying of some of the weak ones happens across industries. It is likely to happen here as well. We are already seeing that the overcapacity that came in, newer capacities that came in over the last 2-3 years, in this tough phase of the last 12 to 18 months, half of them have already died, and some others are going to wither away. So that will leave the field a little more leveled out, as it always does. And also, what it will do is the stronger players, as Arjun said, like what we would aspire to do. We would aspire to go, as you also mentioned in your question, into higher value-added products. So for AZOS, for example, now that we have started with the base products and we are coming at about 55% utilization level, as we move towards 75% utilization levels over the next 6-8 months, we will be automatically towards the higher end of the utilization cycle, going for lower volume, higher value products, and go up the margin chain, up the value chain, and go into HPP, high performance pigments as well eventually, because we see a lot of scope in this business.
Okay. And sir, what would be the difference in margins on a gross level between blue pigment and an azo pigment? Just a rough range.
Blue, as you already know, earlier somebody mentioned it very well. That is exactly the margin profile, about 40%. In AZOS, it would also be similar, I believe. Probably, yeah, I would say similar. We are new, so blue I can comment with a lot of authority. AZO, it will take me a little while to, see how things go, but it should be in the same range.
Got it.
Probably 35% for the AZOS.
Mm-hmm. Got it, sir. And
the capex to turnover cycle is slightly better.
Right. And so, what I understand is the blue pigment is dominated by Indian players, while azo pigment is dominated by Chinese players. But what I believe is blue pigment is more a commodity product than an azo pigment, which you also mentioned. So, why is China more dominant in azo pigment? Because China is more of a commodity play, because they try to sell in bulk, and that is why they get the cost advantage. So if you just help us understand what has happened, which has led to China being a dominant player in the azo pigment business.
This is a very long story. If blue is dominated by India, we have 75, maybe I think 85% of the global market share now, and we will probably in India get 90% even, because I even see further capacity, whatever small capacities are happening in blues out of India may die. So we may end up getting all of it. And in the AZOS, we have only about 10% of the global market. 75% is in China. Now, why this has happened is a very long story, but to cut a long matter short, with blues, the raw material availability in India is complete. It has always been that way. So the majors, when they came from Europe and Japan, they selected India as a natural partner for blue, and hence we created a great infrastructure for the blue business with AZOS, Naphtol, particularly for the red, and also at one point of time, 5 years back, for the yellows, the key raw materials were coming from, were more available in China, and India didn't have these raw materials, the large bulk chemicals for making the AZOS. Hence, the foreign companies migrated to China first, and that is why they developed this trend. What is happening now in the yellow business, just 6 to 8 months back, India has become completely self-reliant. When we started the business a year and a half back, for the yellows, we were regularly buying from China. Today, we don't need to buy a kilo from China. That is how quickly the infrastructure for the AZO industry is likely to change in India.
Got it, sir. And for just one last question. So in your answer to your previous participant, so we mentioned that we are supplying to Sun and Clarion. Just as a company strategy, why do we want to be a contract manufacturer for these players and not directly sell to the end customers or have our own distribution channel? Because only then we'll be able to have our own brand and grow, faster in the international markets. So if you could just explain what is the company strategy over here, or are the customers only looking for bigger players who have better balance sheets or have higher revenue or different product profiles? That is why they look for only bigger players and not smaller players like us.
Yeah, I can take that question. So to answer that question, I think this question is blue, is it?
Yes, for blue.
Yeah. Okay. So for the blues, I think what was made clear at the start of this call, in pigment, we continue to, sell to the top MNCs. We will continue to do this. A lot of our products that we sell to them go into their manufacture of, for example, Sun uses our products to make inks in-house, in their own plants. Now, here we will continue to be their supplier, and we want to be the one they supply to. Here we are able to unlock higher margins than we would by supplying to a lot of other people. So one is that. Second, in terms of the pigment supply, apart from us supplying to them for their end use, we are also able to sell in the market. I mean, we do compete with them as with everyone else when we sell our products in the market, and this will continue, and we will make sure to do this. I mean, in the pigment selling space, we will continue to keep growing ourselves and try to increase the Asahi brand value as a direct product as well. What we sell to the big MNCs, what we will continue to sell is for their use of inks, where we are not competing with them at all. So it is a business that we are doing, where they are buying from us and using that to make printing inks, packaging inks, plastics, whatever that may be. So that will continue as is, and with smaller players and with other business segments, we will use our own brand, and that we will be competing with everybody. I mean, whoever may come. We don't have anyone we won't compete with.
Okay, sir. Thank you for answering my question.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to Mr. Gokul J. Krishna for closing comments. Please go ahead, sir.
So thank you everyone ladies and gentlemen, thank you for attending our Concall. I end this Concall with a very positive note and thought. There is a lot of energy within the company that we have added the new greenfield facility at Atlas. There is also a lot of energy that we have broken even on EBITDA basis. Finally, after a very difficult start to the business and ATC ISO plant in Dahej, and we've already been able to monetize the Saikha land parcel at a very, very good rate and made a good profit from that. So generally, there's a lot of energy that we take away in the last couple of months after a very draining 6 to 12 months. And I look forward to now waiting out for the improved demand scenario to play out, and we should position ourselves to take a very good advantage of it when it comes. Thank you once again, and look forward to having you in my next call.
Thank you. On behalf of Asahi Songwon Colors Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.